DoorDash IPO analysis. Hello, everybody. This is StockerFinance with David Scheuer. I'm your host. Make sure to follow me on Twitter at StockerFinance for more information. Patreon.com/StockerFinance to support the channel. So today we're going to be taking a look at DASH. That's the ticker symbol for DoorDash, who is going to be doing a really big IPO. This is probably going to be one of the biggest IPOs of 2020 since this is such a well-known and popular company who's grown significantly during the pandemic as well as just the past few years. So we're going to be using the Form S-1 registration statement under the Securities and Exchange Commission, so through the SEC, to take a look at this company. This is basically their sales pitch to investors, as well as everything potentially wrong with the company. Now we're going to be looking at the numbers, a little summary of the company, and some really interesting things that I didn't know about this company, especially the amount of market share it's taken during this pandemic compared to other food delivery services. Now they currently have 18 million plus consumers, 390,000 merchants working with them, and over 1 million plus dashers. Now, if you don't know what a dasher is, or if you've never used DoorDash, a dasher is the person who delivers the food. They are not an employee of DoorDash, and that's a really key thing to keep in mind. They are not an employee. They are number one category, US category share, so market share there for this market segment. And in terms of when they're going to actually start trading, so the company filed its IPO prospectus with the SEC on November 13th, and they're going to get listed on under the New York Stock Exchange under the ticker symbol DASH or DASH. So a really cool, simple ticker symbol there, which, not a huge important part of an IPO, but it is semi-important to have a good ticker symbol there for the company. The company will do a roadshow in late November or early December where it will pitch the shares to investors. The stock should be ready to start trading around mid-December. So now let's go ahead and look at our opportunity segment of the S1 form. Now what this is here, it's basically a sales pitch to everybody, talking about why their company is growing, the potential with them, and the opportunity as an investor you may have with this company. So there's a lot of cliches, a lot of wishy-washy words they use throughout this S1 form. Oh, we really care about everybody, our restaurants, we take blah, blah, blah into care, we, local businesses, blah, blah, blah. They use a lot of those different cliches that a lot of tech companies use. But in reality, I'm just focused on the numbers and the actual opportunity when looking at the data for this company. And that's why I highlighted some specific parts in yellow throughout this video, because those are the parts that are really more detailed. And if I read through the entire thing, it would take an entire day because these forms are really long. So we are a category leader in the US local food delivery logistics today and have an enormous market opportunity ahead of us in food alone. In 2019, Americans spent $1.5 trillion on food and beverages, of which $600.5 billion was spent on restaurants and other consumer food services. Over time, restaurants have benefited from a shift away from cooking at home towards dine-in or delivery meals from restaurants, which has resulted in an increase in sales by restaurants. This shift has been particularly announced with younger generations, as younger consumers spend significantly more compared to older consumers on both on-premise and off-premise restaurant dining. We believe the shift towards dine-in and delivery meals will continue, and I believe that as well. I've been seeing tons of my friends. I'm a younger guy, so I've been seeing tons of my friends order a lot of food. I know people who basically only order food, and this pandemic has really pushed that even more, as now people are, maybe forced to order food if all the restaurants in their area are closed down, or they simply feel uncomfortable going out to a restaurant with people. So there's being a lot more ordering food happening, and this company has benefited significantly from that. So in addition to the shift towards dine-in and delivery meals, consumer spending on restaurants and other consumer food services has moved in recent years towards off-premise consumption, with the proportion of food consumed off-premise increasing from 44% of food and beverage spend in 2009 to 50%, or $302.6 billion in 2019. We believe that this off-premise opportunity will continue to grow. 58% of all adults and 70% of millennials say that they're more likely to have restaurant food delivered than they were 2 years ago. And the pandemic has definitely increased all of these trends towards more order and dining, etc., more spending on getting food, etc., because people don't want to go to the grocery store, people don't want to go out to restaurants, whatever it may be. There's a lot more food ordering going on during this time. One interesting thing, though, is during 2020, DoorDash has increased its market share to 50%. Now, remember, this pandemic isn't just benefiting DoorDash. There's others competition. There's other food order services as well, such as Uber Eats, you may know of. Grubhub is a pretty big one. Postmates is a really big one as well. And then a couple others. Now, DoorDash did acquire Caviar, which is a food delivery service. And so they've acquired them, and that they've gained some more market share because of that. But it's really interesting to see that although this pandemic is benefiting all of these companies, why is it that DoorDash and Caviar have the most market share? In fact, 50% of market share, and is continuing to grow. So in 2019 and during the 9 months ended September 30th, 2020, they generated a revenue of $885 million and $1.9 billion respectively. In the same periods, we had a gross profit of $335 million and $944 million respectively, and a loss of $200 million and $433 million respectively. By the way, those aren't the same. So a loss of $200 million and then positive $433 million respectively in contribution profit or loss in 2019. So let's think about, and we're going to talk about here on this next slide, why they have 50% market share. And this little tiny piece on the top is a really interesting part. So they started our business with strategic focus on suburban markets and smaller metropolitan areas. Now, why is that? Why are they focusing on suburban markets and smaller metropolitan areas? This is a reason why I really actually like DoorDash compared to those other companies. See, Uber Eats, Postmates, Grubhub, etc. The problem is they're all competing in the big cities because that's where the most, dense population is, etc. So tons of people are there. They think that, okay, if they can, outcompete their competitors, then more people in the cities, there's more opportunity to get more people to use their services. But in reality, I have a feeling that DoorDash has said, well, you know what if we didn't focus on those really dense cities since there's so much competition, and we focus where there's no competition, which is in the suburbs and the smaller metropolitan areas. So they're focusing on these smaller urban areas. And what's key about this, and what I think is kind of genius, whether they meant to do this or not, is that where are all the restaurants located in a city? Generally downtown, in the bustling metropolitan areas, in the denser populated areas. But where are they advertising? Well, they're advertising in the suburbs, and the suburbs are generally farther away from the restaurants. If the suburbs are farther away from the restaurants, what does that mean they're going to do? Well, if you're a family living in a suburb, it's probably more likely, especially during these times, you're going to order food because you don't want to drive your whole family downtown. It's far away. Why not let someone else drive down there and deliver it for you? Number one, you're saving, you're going to spend some money on gas. You're going to spend some money, you spend your time going and get there. Even though it might be more expensive, it's just going to cost a big fee with it as well. However, it's worth it for a lot of these families to simply not deal with the hassle of driving out to a restaurant and just order the food to their home. And during these times especially, we've seen this extrapolated and growing substantially, this trend of people ordering restaurants. So I think it's absolutely genius that they've been focusing on the suburbs and smaller metropolitan areas rather than these super dense cities like, downtown New York City or downtown Portland or downtown San Francisco, etc. So I think that's really smart on their end. You can tell the industry growth here as well is growing. And let's keep moving on here. So these are their growth strategy. They're just talking about more merchants, more merchant services they want to add. They want to get more consumers. Yeah, that's pretty obvious. Thank you. They seek to increase consumer adoption, and they want DoorDash to actually be a daily activity. So they want people to, be ordering DoorDash all the time, whether it's to your office, for lunch all the time. They want people to spend less time going out to restaurants and more time ordering food. That's pretty obvious there since this company relies on that service. More customer engagement. They have better customer experience. They want to improve their better Dasher experience for all their Dashers. And they want to improve their operational efficiency, which I think is really important as well. Efficiency is everything for this company. So anyways, this is pretty cliche, some pretty basic stuff here. You can read all of this if you want, but I'm going to move on because there's not much more to add in terms of data and hard evidence for this company growing. Now let's look at the numbers, which is where the data and hard evidence is, and it shows that this company is growing substantially, especially in revenue. They grew revenue from 2019, 9 months ended September 30th, 2020, 9 months ended September 30th, by over 200%, from $587 million to $1.916 billion, 9 months ended September 30th, 2020. So that's an incredible one. They went from $587 million, so $500 million, to nearly $2 billion in a year. That's in less than a year. That's pretty incredible. But that's almost all been driven by the pandemic and the lockdown. Again, as I said, people are forced to order food now, or they're just choosing to order food because they feel uncomfortable to go out to restaurants, etc., whatever the reasons may be. Now, is that going to be sustainable in the future? So let's look at 2018 to 2019. We still saw year ended December 31st, $291 million in revenue in 2018, $885 million in 2019. So that still shows that even without the pandemic, there is growth in this company. They're taking market share, they're growing substantially. And I think this has become a habit for people. I know a lot of friends, a lot of family who it's becoming a habit just to simply order food to their home. And even if this pandemic suddenly completely went away, everything's back to normal, I think a lot of people are still going to adopt DoorDash as part of their daily routine. Oh, I no longer have to leave the office now and get more work done, just have my food come right to me. Oh, I don't have to take my whole family and all my little kids from the suburb downtown to go get food. We can sit down, watch a movie, eat our food, and get it delivered right here. I think it's going to become a part of people's, weekly or daily lives more and more. Now, total cost and expenses. Let's look at this because this is important. Is this company actually making money or are their expenses out of control right now? Well, in 2018, we could tell that their expenses were out of control. $501 million in total cost and expenses compared to $291 million in revenue. 2019, same thing. $885 million in revenue, $1,501 million, or $1.5 billion in total cost and expenses there. And if we look at 2020, well, the gap narrows significantly, $1.9 billion, but just $2 billion in total cost and expenses. So it narrowed significantly during that time period, which is a great thing to see. And although they're losing money right now, so we have a net loss of $204 million back in 2018, they now have a net loss of just $149 million in 2020, but it's also just 9 months ended, so the year is not completely up yet. We saw that loss increase from 2018 to 2019, so $204 million to $667 million, not what you want to see, but hopefully that loss is starting to decrease, and hopefully it'll continue to decrease as they increase their efficiency with this company. They also did some acquiring during that time, etc. So there's a lot of things going on that they're spending money on promoting, but hopefully my goal for this company, or their goal should be, to take as much market share as possible, run their competition out, and then have a, somewhat of a monopoly on this industry. Everyone only uses DoorDash, and that way they can raise their prices slightly since people are addicted or used to using DoorDash, just like we're seeing with a lot of these tech companies doing, or other tech companies like Google with their services. They get people hooked on it at really cheap prices, and then they slowly raise prices or create new prices for their services since people are hooked on using their service. And in this case, it's food delivery. So now let's look at their consolidated balance sheet. And man, did they take consolidated all the way. It seems like they're consolidating more and more on these S1 forms. Holy moly. So cash and cash equivalents and marketable securities. In 2018, they had $556 million. And in 2020, they have $1.6 billion. So that's great. It's a lot of cash and stuff they're working with there. Working capital of $1.1 billion. That's great to see as well. Now, total assets, $2.8 billion. So as long as their assets are increasing, which we are seeing from $683 million in 2018 to now $2.874 billion in 2020, that's really good as well. Total liabilities, we are seeing an increase as well from $134 million in 2018 to $550 million in 2019. And then the 1,441 billion or million, sorry, I don't know why I'm freaking out, 1.441 billion. There we go. Geez Louise, talking too fast here in 2020. So in total liabilities. Yes, they are trading, at a stockholders deficit, or they will be once they go public. So they have a deficit of $436 million in 2018 and then $1.2 billion in 2020. Now we want to see, especially since that stockholders deficit is growing, hopefully they can decrease their liabilities or at least slow the rate of growth there as their total assets rate of growth increases over time. That way they can get that total stockholders deficit. Eventually it will trend towards positive. And that's really what you want to see as an investor, especially a preferred shareholder. So let's move on here. Let's look at total orders. So total orders here, we're looking at 83 million in 2018 to 543 million total orders in 2020. That's awesome. And if we look at adjusted EBITDA, which is earnings before interest, taxes, depreciation, amortization, we're looking at a loss of 158 million in 2018, but an actual profit of 95 million in 2020. So that's great to see for this company that they're able to pull that off. And although it says adjusted, it's still great they were able to do that there. If we look at contribution or profit and loss as well, we can see that they were able to do a profit of 433 million in 2020. So it's awesome to see that. Let's move on here. Now, here is just some little information. We can skip over this part or just skim through it really quickly. Talking about how they serve over 390,000 merchants to help grow their platform. They're talking about how they have over 18 million customers and they have over 1 million dashers, but we already kind of went over that. If you want to read through this, you can pause the video and go ahead. It's just a lot more detail, but there's not too much more information to get out of that segment about whether we're actually going to purchase shares of this company when it goes public or not. Now, when they launched in 2013. Their first delivery was completed in Palo Alto, California in October 2019. Dashers completed 1 million deliveries in a day for the first time. So that's incredible growth there. They expanded their coverage. They expanded to the East Coast in 2014. Today, they're in all 50 states in the United States, as well as in Puerto Rico. And they've also expanded internationally to Canada and Australia. Now, that's great to see because they're really not in that many places yet. Canada, Australia, yeah, all 50 states is great. Puerto Rico, but they have a lot more room to grow around the globe, which is good to see for this company. That's a lot more potential. Now, expanded selection through national brand partnerships. They partnered with a bunch of different, people such as California Pizza Kitchen, as well as, McDonald's, Chick-fil-A, Wendy's, Wingstop. So all the big franchises they've partnered with, which is great to see for this company. Now, scaled DashPass. They launched DashPass, which is a membership program to the world in 2018, and as of September 30th, 2020, they have over 5 million consumers on DashPass. Broadened their merchant services. They acquired Caviar in 2019. It was a coveted brand, premium restaurant selection, and leading technology. The acquisition, they say, advances their strategy of offering consumers differentiated merchant selection and enables us to cater even more food preferences and occasions. I think that's part of the reason, but I also think the bigger reason is they want to continue to take market share from their competitors, and that's allowing them to do that by acquiring Caviar, although it was a pretty expensive acquisition. Now, here's total orders. You can see the growth. It grew immensely in 2020, but it is steady growth without a doubt. And even if it slows slightly down when the pandemic ends, I think it's going to continue to grow as they expand throughout the globe in new countries such as, Australia, Canada, or whatever it may be. Marketplace GOV in millions. See insane growth in 2020 as well. No surprise there, at least in the second half of 2020. Now we can look at GAAP gross profit, and then we can look at contribution profit or loss in millions and contribution margin continuing to rise. Same with gross profit, which has grown from Q1 in 2019 of 31 million to 469 million in Q3 of 2020. Gross margin grew from 23% in Q1 to 53% in Q3 of 2020, and that was Q1 of 2019, by the way. So the fact that their gross margin is growing, that's awesome to see. Same with gross profit. Their contribution margin is growing as well as their contribution profit or loss. So all good news there on the growth side for this company. If you look at net income in Q2, they had a profit of $23 million. So that's awesome that they made an actual profit in Q2 of 2020 and a net margin of just 3% during that time. But the good thing is we can see that their net margin is trending towards positive. And if they can sustain that margin and they can cut costs or whatever they need to do to sustain a profit over time, that's going to make investors like myself way more confident in this company. Now let's move on here. Just the last thing to wrap this video up. DoorDash is available in over 4,000 cities across all 50 states, including Washington, D.C. and Puerto Rico, 80 cities across Canada and towns. DoorDash is also available in Melbourne, Sydney, and Brisbane, with more Australian cities coming soon. So the fact that they're expanding their business is great to see because volume is everything for this company. If they want to bring that margin down, I really think this company needs to cut some costs, whether it's marketing costs, whether it's, staff costs, maybe, whatever it might be. I think they do need to cut some costs wherever they can to make this company and better their margins to make this company sustainably profitable and not just profitable for one quarter. Anyways, here's a quick summary of how I feel about this company. It's hard to value currently. We can place, an exact value, but it's going to change a ton when it goes IPO. Big investors are going to invest before everybody, especially institutional investors. So retail investors are not going to be able to get a hold of that value. So I'm not going to tell you an exact market value for this company right now because it's going to change so much. I expect the IPO will be very overvalued because this company is so well known. It's going to be a really big deal all over the news. Tons of retail investors and institutional investors are going to be purchasing this company. And that's not the worst thing ever, but it is something to be careful of because if it gets too overvalued, too hyped up, we could see it balloon out of control and you wouldn't want it to you wouldn't want to be buying at some insane price, even if you like the company. Now, lots of room to expand. I've seen this company is growing really rapidly. They need to figure out sustained profitability, whether it's cost cutting, whether it's, whatever it is, and they need to increase their profit margin, their bottom line, so they can sustain a profit, even if it's just a small profit. No one wants to be purchasing a company that's operating at a loss, or at least doesn't have a path towards profitability. But it does seem like this company has somewhat of a path towards profitability since they proved it. It's not like they've never been profitable before. They were for that one quarter there, but they need to make that sustainable. Cost cutting will probably be necessary. They're taking market share, which is great. And I think their competitors are suffering a lot right now. Uber Eats is losing tons of money for Uber. That's not sustainable at all. Postmates seems to be shrinking more and more. The service has really been hated on. People don't like the service as much. They're not paying their their carriers as much. Grubhub's doing pretty good, but it's also losing market share to DoorDash. So that's great. They're benefiting from the lockdowns. It's been profitable. And since throughout the US, we're going into another phase of lockdowns right now, it's going to further benefit DoorDash as restaurants are forced to shut down and do delivery only. It's been profitable, so it is possible to sustain profitability in the future. Might buy during the IPO rush. Personally, this isn't investment advice, just my own opinion. It's for entertainment purposes only. It is a risky investment right now, just like most tech companies at the moment. There's a lot of overvalued companies out there, a lot of volatility right now. It's very uncertain times. There's a recession. We had tons of different things. Although the unemployment rate has been, returning back slightly, we've seen people starting to go back to work. This next round of lockdowns is definitely going to hurt the economy slightly. There's been some good vaccine news, but it's not confirmed 100%. People aren't going out and getting vaccines yet. So definitely a risky time right now for investing. But this is a really interesting company and one that I particularly like since I use the service occasionally. And I like the way they're growing, and I like their strategy of taking market share from competitors. So anyways, thanks for watching. Please subscribe. Make sure to check out these videos as well as follow me on Twitter at StockerFinance. I post updates there about the market, etc. If you want to support the channel and help me out, go ahead. It's patreon.com/StockerFinance. I do personal portfolio updates there, as well as any buys or trades that I actually personally make. So you can definitely check that out. And anyways, I'll see you guys in the next video. Peace out.